Africa is a continent open to possibility, which comes to life when those with ambition and courage find the right partner, a partner with the tenacity to stand by them and light up a continent. With the experience and unique insights to go beyond limits, Absa Group Limited is that partner. We are synonymous with stability, transparency, and innovative thinking in financial services based on a legacy of 100 years of seamless execution across Africa. Our new brand and growth strategy define how we are shaping our destiny as a proudly African bank, inspired by Africanacity. This is the distinctly African ability to always find ways to get things done. Africanacity is what drives us, what sets the tone for our business, and echoes across our African footprint. Our corporate and investment banking business challenges limits. We close distances, connecting people to opportunities across borders, languages, and cultures. With global connectivity and local differentiation, we operate at the core of your strategy. Our understanding of each unique environment across regulatory and market practices results in a differentiated service and experience for our broad range of clients. Backed by insights into key sectors, we turn risks into opportunities, supported by a unique set of solutions that work across your full value chain. Our clients experience a seamless partnership across Africa, with aligned delivery positioning you for success across operating environments. Because African ingenuity and tenacity go beyond limits, so do we. Our world-class service is based on skills and expertise that have been developed to put our clients first, proven by numerous high-profile deals and coveted international awards. We are brave, we are passionate, we are ready. We are independently African, and we believe in building courageous partnerships that work. When you have the bravery to imagine and the will to get things done, that's Africanacity, that's Absa. Corporate and Investment Banking.
Good day to all the participants and welcome to the RCL Foods, a pre-closed update. I am pleased to announce that we will be in conversation with RCL Foods, Chief Financial Officer, Mr. Rob Field today. On behalf of Absa and the online audience, we extend a warm welcome to Rob and thank him very much for this opportunity today. In terms of how the session will be run, I will kick off by asking questions and will pause after every segment or section to pose questions that come through via the online chat. So to the audience, if you do have a question today that you'd like to ask management, do post them online and we will ask them on your behalf. Rob, perhaps if you can kick off the session with the first question, which is, could you kindly provide a general overview on current trading conditions?
Sure, and thank you, Samantha, and hi to everyone. It does feel not as great to be sitting in front of you and I'm staring at a screen. I get to look at the pretty face of Samantha, but unfortunately can't see the audience. But good morning to you all, and yeah, to respond to your first question, it remains tough. Obviously, we've recently released all of our year-end results, and the environment has not got any easier. In fact, it's got more difficult. Excuse me, I'm carrying a bit of a cold. Even better reason to remain in a virtual space. But you know, the riots that took place post our year-end in July have set a heavy tone for us for where our business is based. And I think the trading remains no different to what we've experienced over the last 12 to even 24 months in terms of being exceptionally competitive. But I think the new dawn of challenges is around the consumer and the inflation pressures that are coming upon them like never before. So it makes it very difficult for us in the middle in terms of trying to sustain our margins, trying to do the right thing in terms of putting affordable food on the shelves and in our consumers' homes. And I think our last 12 months results demonstrated our ability as a business to be able to bring innovation that is relevant to these very difficult times to the market in almost all categories, and that momentum has continued into this interim period. We were fortunate in being able to grow most of our market shares in the context of declining markets volumes in every single one of the categories that we're trading in, whether you look at it from a 3-month or a 12-month moving basis, are in negative territory. So that poses a very significant challenge for us in terms of getting our volumes through the system and recovering the cost input pressures and to try and sustain our margins. So I would offer that the environment has never been tougher, to be honest, but we continue to hold our own. Our market shares are looking good, and that's where we've got to take the fight to. And if the market around us is declining, we've got to grow our volumes through market share.
Thank you, Rob. And perhaps to build on the response that you provided, are there any specific comments you can make around consumer shopping behaviors in terms of, are there any noticeable changes across products or categories? Also, if you could chat around promotional activity and what level you're seeing in the market relative to pre-COVID levels. And lastly, also, we would appreciate if you could touch on private label versus branded products and the dynamics between those two products in terms of growth and market share. We would appreciate some color on that, please. Thank you.
Sure, and again, in this short window, not much has changed in that space. And I think COVID has been with us for a while now and has forced a change in terms of how consumers are interacting with our products, how frequently, which is less, that they are going through to the retail stores, how much more they're using delivery mechanisms, which you only have to look how successful Shoprite's 60/60 or Checkers 60/60 is going, and they're being forced to trade down, unfortunately, and that's where some of our innovation plays into that space. Our basket of products, which is across the spectrum, but definitely offers entry-level and affordable food. And certainly with more in-home consumption, we've had a strong volume showing, and that again has continued into this interim period. But there's no doubt consumers are trading down. They're trading down to smaller pack sizes. They're shopping less frequently, and so that poses a whole new realm of challenges for us to support our consumers and make our brands even more relevant in their space. So what we've got is obviously pressure coming from the retailers in terms of, and there's a very big fight going on, excuse my home bell then. There's a very big fight going on in terms of the relative shares, and they're no different to us, are facing absolute market declines, and so they're fighting it out. And I think the winners are no surprise to this audience. Shoprite continues to do exceptionally well. And Boxer in more wholesale spaces similarly doing well, but for the rest of the retailers, it's a very tough space. So that context is important for the types of conversations that we end up having, and the pressure that they place us under from a promotional activity perspective. So we try and continue to do what we're good at in terms of putting the commercial propositions and not just low price for the sake of it to move the volumes. And we've been mostly successful in that space. So the pressure is real, not suggesting it's not, but our single-minded focus at the moment is to retain our margins in this very difficult space. The private label theme continues, and there's no significant shifts happening within that space. If you read any of the strategies being put up by the big retailers, it's a key feature of their world. And I think, as this audience knows, us as RCL Foods, have a reasonable exposure to this. In any particular category, it varies, but it's never a significant part of our lives, and we always convince ourselves that it's in the best interest of our relationships with the retailers, as well as our own volumes through our system, to manage the presence in both. What we will not do is compromise our brands and their positioning. But in some categories, take sugar, it will, for instance, have a higher presence in our space. But we will be very careful to manage a category like peanut butter, where we've got a very strong branded presence, to venture too far into that private label space. So yeah, it's a reality that we live with, and we work around. We don't think that there'll ever be a time or destination where we will only be in a private label space. So we remain hardened brand producers, and think that they've got relevance, particularly in the South African context, where South African consumers are very brand loyal. But no doubt what's happening is each of the retailers are going up the value curve in terms of positioning their own products, and possibly historically more in a value offering in a private label sense, and really taking some premium positionings now with some of their private label. Again, Shoprite is setting the pace here with their fresh offerings, their premium offerings, their Forage and Feast. They really are setting the tone for local retail, and shifting away from that previous connotation of private label equals low cost or quality compromised product.
Thank you so much for that, Rob. And my next question, and perhaps you touched on it a bit, is regarding the inflationary pressure on the consumer. What has been the impact of elevated commodity prices on the business over the last few months? How has RCL Foods mitigated this? And is there any outlook that you could provide on cost recovery and inflation going into the second half of the financial year?
I wish the story was different, and when we spoke to the market previously, it was the markets were heady, and we were hoping for some kind of retracement, because the best cure for high prices is high prices themselves. And but as we sit here today, that picture isn't any better, materially so. Some of the forward markets are suggesting that through the inverse trade, that there's likely to be some relief coming in March, but it is relentless over the last while, and so it's very worrying for us. And so we continue to expect that inflation will run, well north of the kind of 6-7% that it's posted at the moment from a food perspective, at least for an extended window. And we can watch all of those markets. We as a business have exposure to most of the soft commodities. And where some of them are imported, obviously that carries an exchange rates impact as well. Most of them trade on an implicit import parity reference anyway. So with few exceptions, perhaps maize, do we get an export parity reference? For the rest, it's an import parity, and a very difficult outlook, whether it be wheat, soya, peanuts, sunflower. It's not a good space. So our response has been resolute as we can, in terms of we've taken very frequent price increases to the markets, and obviously it differs by the different categories, depending on their implicit cost push impact. But that job of work is getting harder every single day, and we understand that pressure. So it is a margin retention game that we're playing, but there is pressure every single category that we trade in, and so we're doing, and we had up until June, and we continue to do the best job we can within that space. And I would suggest our head is above water, but it's not a nice space to be in.
Thanks, Rob. And perhaps to build on the topic of costs, what risks do you see for the business in the case of South Africa entering into a fourth wave of infections?
To be honest, no new risks. In fact, we've become very COVID enabled as a business. We said at the outset of the pandemic that our staff and their welfare was the most important thing for us. Continuing to feed the nation through our operations, continuing, and then thirdly, focusing on cash preservation. We've done all three of those very successfully. We as an organisation of over 23,000 people have unfortunately 27 folk suffer and die as a consequence of the pandemic. So it's very real for us. But I think in terms of our demonstrated ability to continue to operate, that has been unwavering, and that's thanks to the commitment of our staff. So to be honest, there's nothing new about the fourth wave. Obviously, it concerns all of us in terms of the mutations and whether or not the vaccines will be effective against these new strains. So it's something we watch very closely, but no new risks. I think it's just a continued focus on keeping our staff as safe as possible.
Thanks, Rob. And my next question is perhaps broad, but could you shed some light on how the strategic portfolio review across the group has taken shape since the company's FY21 update?
So obviously there's been no announcements made, so it remains something that's in progress for us. Just to kind of remind everyone, we settled on a positioning that says the branded value-added component of our business is what we want to grow and build our nucleus around into the future, which means that over a well-considered time frame, we will look for strategic options for each of the chicken, sugar and logistics businesses. We're running that process concurrently for each of them. There are reasons for why some of them would be able to go ahead of others. Nothing's changed from a chicken perspective in terms of the struggles within that business, which removes some of the optionality that we would otherwise consider for it. But we are resolute in terms of we will find a strategic answer for each of those businesses, which could be different for each of them. And we're hoping that by February, when we bring our interim results, we'll be able to update the market in terms of progress. Suffice to say for now, lots is happening in the background, lots of conversations with various parties to reach out and understand how best we can extract value from these businesses and bring necessary partners into the business. And this audience is also aware that we have a investing empowerment scheme, which in H2 will come, and it's the second scheme we've had in place that unfortunately is going to vest underwater, so no value passing to the participants, the majority of those being our staff. And so that's another element in this overall mix that we're trying to provide for. And again, the dynamics and demands of each of those underlying businesses is different in that regard. So it's there's a lot going on, a lot to consider, but we are making progress.
Thanks, Rob. Appreciate that. And my next question is, are there any comments that you can provide around net working capital and CapEx spend together with projects against full year targets?
Nothing specific other than to say the working capital piece obviously suffers the brunt of the inflation pressure. With all those soft commodities as heady as they are, unfortunately that translates to an investment level in working capital which is higher than what we would like. So that remains a key focus for us within the business, to get those absolute levels down as low as possible without compromising the business, accepting that the rate is beyond our control. CapEx, we have guided that CapEx spend is going to be, and certainly replacement CapEx is going to be a bit higher in this financial year. And by virtue of, if you look at it over the last 5 years, the challenges that the business faced in 19 and 20 meant that we were very prudent in terms of the extent of replacement CapEx that we released to the business. It's nothing untoward, but it will be slightly higher than what we've had in previous years. There are not many significant expansion CapEx, and I'm happy to talk to them, but in the system at the moment, largely goes around our baking footprint and Vector's repositioning of its rationalized infrastructure. Other than that, there's not a significant amount happening within the business. So expect an uptick in CapEx for this year, but I think that's just a rectification of 2 prior years lean allowance in that regard.
Thanks, Rob. So we have a question that's come through online. It has been posted anonymously, but the question is, which areas in the business are showing overall volume declines, and are there any areas that are perhaps showing a rise in volumes?
So it really is a mixed bag. I mean, as I said at the outset, and this is readily available information, I'm sure the audience sources it for themselves. But all of the categories that we trade in, the markets are in decline, and some of them as significant as 5-6% from a volume perspective. That's very worrying. So it really is a mixed bag. I think the COVID affected categories are the ones that have probably seen the most movement. So our pies business, being a largely on-the-go consumption, was heavily impacted at early lockdown. But obviously there is more movement of people around as we speak now. Still a level of restriction, so those volumes have bounced back quite nicely. Our beverages category is another on-the-go consumption item, but remains challenged. Our grocery lines are really holding their own. I mean, the fact that our market shares remain strong and if not have improved means that relative to our competitors and relative to the market, we're showing a better performance. So there's no great shakes within that space. It's more of a steady performance across all of our portfolios. The area that is probably under a little bit of pressure is our specialty business, is the chilled cakes and desserts and the bakery lines, the specialty lines that we do for Woolworths, and those volumes have been under a little bit of pressure. I don't think too much must be interpreted into that, because if you flip across to our baking business, so where our 7 bakeries, we're actually performing really nicely from a volume perspective, and obviously looking forward to the new investment in terms of the new line coming on stream early F23. So a mixed bag, but generally positive, and you have to put a good performance tag to that when you consider how the market is trading.
Thanks, Rob. We'll move on to the various segments now. So firstly, starting with the FMCG segment, and you've already touched on the bakery business, but if you could provide a little bit more detail, we'd appreciate that. Just in terms of how the business has fared in, relative to some of the industry dynamics relating to competition as well as pricing.
Yeah, and always worth reminding the audience, most are aware that our baking business is largely a rural footprint. The bakeries that we trade in, and even where they are in the centres, the profile is nowhere near, in terms of a customer split, as significant as our major competitors, called the Big Three, who are big retail front facing. So we're more in general trade. That is the strength of our brand. And our positioning around the more rural parts of the country, and we continue to enjoy a very strong performance. Our brand is strong. It resonates well. It's got a great positioning, certainly in the more urban space in terms of the price relativity for its quality. We will contend, and others have told us the same, that we've the best quality bread in the marketplace, and that may sound surprising, but it's a simple logic of that we've got the biggest and best mill in the country, which enables us to grist many different varieties of wheat to get the best quality flour into our bread, which is, if people know the history of Ruto Mills, that was its very strong positioning with bakers. So it goes to that theme of, and you have it as a latter question in terms of the forward integration, and that really is the success factor for us. It's our key strategic thing that we're pursuing. Hence, pursuing volume expansion in our bakery, where we get the uplift from a margin perspective using high quality flour that's available to us. And as we stand here today, we have the lowest utilization of our own milling capacity into our bread relative to our competitors, and that is an easy capture the margin positioning, and then we're taking quality brand into new territories with Sunbake. So an exciting plan of ours. We're on track in terms of ratcheting up those volumes as that capacity enables. But again, as said, that new Polokwane capacity is only going to come on stream in F23. And so it's more of the same for now, and just doing a better job of the margins within that space by virtue of the competitive positioning of our brand.
Thanks, Rob. My next question is around the pie and beverage business, and relative to the FY21 update, how has the recovery across those two segments progressed?
Yeah, so touched on that a little bit. We had commissioned capacity expansion as COVID hit in March last year in our pies business. So it was the worst possible timing. We had some very significant momentum with the brands leading up to that, which gave us the appetite to invest more. So we're back on track. It's been a very difficult 12 to 15 months, and because of that lower on-the-go consumption. But the volumes are coming back in the pie space, and we are bringing market-leading innovation, and that's what our retailers are playing back to us. It's a very important opportunity for us to partner with them in their delis and their bakery sections. And then the area of the business, obviously, that's bouncing back is forecourts. And the Pieman's brand is traditionally very strong in that space, and that's where COVID's knock was most significantly felt. So pies is doing nicely. It's still going to be some time before we get back on track in terms of utilizing that additional capacity that we got in, but we're feeling more confident as we stand now. Beverages is similar on the go challenge, but I think our issue is more with the brand itself. It is a category that has had intense competition. Madu, a number of brands have come into the market from nowhere and brought in a more value-added dairy type based offering, which credit to them has grown the category, but also stolen some market share. So where ours is more in the traditional maize-based space, where we're trying to extend into more premium offerings. That's been a bit of a struggle for us, unfortunately. So that business it remains under pressure. It is not a significant part of our overall business, so it gets the necessary attention, but obviously we're making much better strides and headway in other parts of our grocery lines.
Thank you, Rob. My next question is on the specialty business, and you've already touched on the category dynamics, but I guess my question is around the site consolidation that was guided for at the last financial results. Should we expect any disruptions from that particular project?
In short, no. It's a well-planned project. It's on track. It's going to offer us significant, well, let me not say significant, it's going to offer us some cost advantages and obviously just better control operating out of a single site. And leaving behind a rented facility that was problematic in terms of its location. So it's good moves all around, and the teams have done this kind of stuff before, so no concerns from a physical supply and disruption point of view. It'll take some time, obviously, for the benefit of it to flow through the system, but all good.
Thanks, Rob. I know in your earlier responses you spoke extensively about volumes and growth in that respect, but are there any specific comments you're able to offer around the spread and cream business, and are you confident in market share gains in terms of when you report in the full year?
Can I just confirm, in your reference, you're talking to mayonnaise?
And the peanut butter category.
Okay, because we have a strange thing within our business. Spreads actually references the margarine business that we look after on behalf of Remgro, but I know that there is the different reference. So very confident, in short. And those brands have been powerhouses for us, done a really good job. Initially, it was the storyline was about increased penetration into the markets. But you know, they've done exceptionally well from taking on two very strong competitors in each of the categories. So there's no change to that momentum. They continue to hold very strong market share positions. We believe it is being sustained by the level of innovation that we're bringing into those categories. You will see some economy options being launched and not already on shelf. So again, going back to kind of the context of the times of doing what's relevant for the consumers that are hard pressed at the moment. But we don't see any change in those two categories specifically. The good job of work is in our base now, and now it's about sustaining it.
Thanks, Rob. And perhaps a follow-up question on the peanut butter business. Is there any update you can provide in terms of the peanut butter tariff application?
Sadly not. I wish I could. The application went in, I think, in June. So what are we, 5 months down, nearly 6 months down, and not a peep out of ITAC. I mean, it is just such an obvious issue for those that aren't familiar with it. You will pay no duty on finished product, peanut butter coming into the market, which it does. Some of the retailers bring it in, but you pay a duty on raw peanuts, which obviously is an input to our process. Why? Because most seasons we don't have sufficient supply here locally, and the peanut crop is very variable, so we're obliged to import. It makes absolutely no sense. Conversations that we've had with the minister is easy because it's so obvious, but as we sit here today, nothing has been done about it yet, unfortunately.
Thanks for that update, Rob. My next question is on the Live Kindly initiative, which is aimed at the plant-based protein. Just to get an indication of how this initiative or business has performed in the SA market thus far.
So I need to preempt it with its very early days. Again, a reminder that the presence of the Live Kindly collective in the South African market is actually ahead of the balance of the markets that they participated in by virtue of Fries being part of the initiative. So what we're rolling out now is bringing the new brands that are international into this marketplace. Those of you that have looked out, you might have already seen a brand called Oomph, which is going to be an absolutely stellar brand for us. Got everyone excited. Taste profile second to none. So we're very excited about it, but this is building a market. South Africa is not a very big vegan or vegetarian market, and it has a dominant position within that space. But there's a huge amount of activity and belief that it's going to be growing. And what we are most attracted to in terms of the Live Kindly positioning is that they're not going for it as a niche offering. They are targeting flexitarians, which is the right way to go as far as we're concerned. You know, get people to convert 1 meal a week and then two meals a week, by giving them quality offerings that are affordable. And in the long term, when scale is behind this business, they will be able to be affordable and should be significantly cheaper than protein, animal protein alternatives. So it's very early days. We remain very committed to it. If you look into that Live Kindly business, do some searching on them. They are shooting the lights out. But have a 5 to 10 year dream that is being pursued here. This is not going to be a significant contributor into our world for a while, but that doesn't mean it doesn't in 5 years' time going to reckon as a very significant category in our overall makeup. So we're excited with the link up that we've got with Live Kindly. We're very excited about the brands that they're buying internationally. That we will be able to, as appropriate, plug and play into this market. The challenges that we're dealing with in the short term are obvious ones in terms of, how do we get the base protein or sufficient of it here to manufacture these products locally. And when you're starting from zero, there's not a lot that you can convince people to invest. So we're going to be on an import profile for a while, but we need an answer for that in the short term, not even medium term. So overall, a great degree of the excitement within the teams, but it's going to take some hard yards and take some time.
Thanks, Rob. Appreciate that. I guess against cost pressures and the business's focus on margin retention, is there any commentary you can provide around operational efficiencies in the FMCG division?
Nothing specific, because it's in our DNA. I think we've had something which may have people would have picked up in our narrative and our language. This goes back 2.5 years in terms of a shift in all our areas, all our businesses, to focus on the things that are controllable. And unfortunately, in many of our business areas, there are lots of uncontrollables. And so we've shifted our emphasis and take a business like sugar. I mean, it had a record performance last year. Why? Because we were absolutely fastidious about the things that we could control. The market factors came along last year and were all conducive to a good result as well. But we offered that more than 50% of the upside came from things that we did in the business. So from a cost and efficiency point of view. So as an example, I think those 3 sugar mills were the best performing sugar mills in the country, and by some distance, which contributed to the sugar result. And so we have a centralized supply chain focus that drives that discipline across the entire business. So whether it's a grocery site or a bakery or a big sugar mill, and the disciplines are all the same. And so we've seen consistent improvement across all of our operations in that regard, recognizing that it's in that camp of we can control some stuff. Let's focus on that. So it's no surprise to us that the underlying businesses are doing better, still equally and as before exposed to the uncontrollable and call them rate type impacts and legislative type impacts, but we do what we can. And that shift in focus has paid dividends for us. So there's nothing specific to say that we have revolutionized any particular area of the business. I think it's just hard discipline that pays dividends there.
Thanks, Rob. And could you also elaborate on perhaps some of the pricing strategies in the grocery division, given the volume pressure that's been seen at the moment?
Yeah, I've touched on this. We count ourselves as very responsible producers, and what you don't want is your volumes to fall off a cliff. And by pushing price too hard, that's exactly what happens, even if it's needed or deserved or. So we've done as many price increases as we can. We've taken them to the market. There's another round of them coming early in the new year. just because the input cost pressure has been relentless. But our commitment to our trading partners is that as soon as we see that relief, we'll be the first to rectify that too. So we're doing necessary cost and price increases to recover costs. That will translate to some level of margin pressure. There's no blowouts happening in any parts of our business, but it's the consumer is the one that's playing back to us, and you see it in all the categories, as I mentioned, so being negative from a volume perspective, and saying enough is enough. But we've also got to stay in business. So we've got good relationships with the retailers and our customers to be able to do that job as responsibly as we can, but it's really tough.
Thanks, Rob. Perhaps if we can move on to the sugar business. Is there any commentary you can provide on this division's performance relative to sugar prices, as well as the focus on margin restoration?
Yeah, so remember the context is our sugar business delivered 900 million rands worth more EBIT than Tongaat sugar business did, so for the comparable period, and so it's had a record year, way above any performance even in the old days that it has delivered, and as a composite of factors. So we are quite energized by our sugar business in terms of its performance and how significantly that turnaround can demonstrate itself. Not all of the factors are as positive as they were for us last year. We had very late rains, so a very dry summer last year. And when the rains came, they came in their floods. Not a real flood, but in a short space of time. So our yields are down this year. It just is what it is. We've had infestations of aphids, unfortunately, and that's been across the entire industry, Swaziland, and ourselves, and to some extent here in KZN. So the absolute volume of cane that's going to come through our system won't be as high as last year. But we continue to influence as best we can that the bulk of that produced sugar here is sold here, which is the key equation in determining the profitability of the industry and certainly of the millers. So there remains a conducive external and international sugar price. So when we have to export any portion of our raws or white premium willing, some of the refined sugar, we're getting an acceptable price out of the international markets. So the sugar business is still in a good place. We guided toward that in terms of our prospects. Nothing's really changing. It's a business that has the vagaries of crop health and yield issues. The mills are still performing well. I will use this opportunity just to share with everyone, because it is in the public domain to some extent. There was a lot of press around it, but the sugar store at our Komati mill sadly burnt down in September, and a very significant stockpile of sugar. It was in the local press. We lost 41,000 tons of sugar, which when you do the sums is a very significant number. The reason we're not out in the marketplace with any kind of announcement in that regard, obviously, is that our insurance has already and will continue to respond to that. So we will have a first deductible loss in this period, which is very unfortunate. But we're still finalising the cause of it. Very, very unfortunate, and just seems to be one of those things that happens. We're a bit unlucky when it comes to fires, but it was a big one, and will hurt the sugar's performance this year. But as I say, probably more limited to that excess loss, and because most of it should be recovered from an insurance perspective.
Thanks, Rob, for that update. Appreciate it. I guess a broad question is, what progress do you observe from the Sugar Master Plan?
So pleasingly, some good progress. and I'll give a completely different answer when I talk to chicken later. But you know, the industry has always been well organized. It's to some level of criticism, you know, it's too bureaucratic and too big, but it means it's got the ear of government, has historically, has an effective tariff structure in place. And this agri space is obviously very close to government's strategies, and know how important it is for our economy and employment, because it is a big employer. So the master plan's tenants are good. There are, I think, 10 task teams beavering away at the moment, all with different levels of progress being made. And all with a very common agenda to make this industry efficient and sustainable, and understanding that there is some very significant dependencies through the value chain. So we feel like it's in a good space. Obviously, you always want progress to be stronger and quicker, but the right conversations are happening. There are still the same tensions within the industry. I don't think that's ever going to go away in terms of between growers and millers, but it comes together as well as it can within the body of the industry. And the master plan is something now that's just galvanizing both. You know, some of the other market players have looked at our last year's results and said, we can improve the status quo. We can make this a more sustainable industry, and one that we want to invest further in if we do the basics right. So the continual shift, I think, will play out. I'll say it plainly, from our perspective, the KZN industry just needs to continue getting smaller and smaller. It's an underinvested space. It's not the optimum place to grow sugar. It borrows off its sustainability from the industry participation. So it's if it had to stand on its own 2 feet, I would venture that it wouldn't be there. And our operations and this, say what it is, the Swaziland operations, which are even more efficient than the South African operations, is where our Southern African sugar should be grown and produced. So this is a long game, but we're strong participants, and are feeling fairly positive at the moment.
Thanks, Rob. So we have a question that's come through online from a participant, Chris Logan, who says, thanks for the update. His question is, on the sugar side, you mentioned how well you are doing. Is there not an opportunity to buy more assets from Tongaat, given the current state?
Chris, nice to hear from you. It's an easy, short answer. Why would you buy a loss-making operation? So no. A number of years ago, prior to our involvement, TSB bought Ilovo's Pongola mill, which also enjoys good growing conditions, and is easily accessible for us from where we're based. And our view is that the KZN industry must just get smaller over a period of time, and those mills must continue to shut down, and crop switching must continue too. There are better crops to be grown in the KZN area, and so no thanks.
Rob. Moving on to the chicken division, my first question is the separation of the poultry business guided to take place in the second quarter of 2022. Is this on track?
So yes, it is, and it's happening in different levels. So in terms of how we operate internally, it's completely separate. It has an independent team that Paul and myself and just have oversight and regular contact with, but for the rest of it, they run the business. The challenge that they have, as I said earlier, in terms of contemplating future opportunities for their business, the timeline is unfortunately going to move out by virtue of the extension of the difficulty that they're experiencing. That's not good news, but it is just the hard reality of it. The business is challenged not only from the breed perspective, that it's in the progress of changing. That was the key issue previously to what are now the highest input cost environment we've had for a very long time. So really struggling from a return perspective. But in terms of how we operate, very separate. Clearly, there's not a easy cut in terms of, and they were very integrated into what we call our platform, our business services organization. So we still provide all the back office support services, but they run all the operations, they run all the front end, but we share a SAP system, we share a payroll, all the obvious things are still linkages to them, but those are not strategic, those are not things that change fortunes of the business. So that's as the status quo will remain until the business can be properly turned around.
Thanks, Rob. And perhaps you've already touched on this, but is there any additional commentary you can provide on the chicken business performance related to animal feed costs and also with the breed challenges and the focus on cost management?
So the sad reality is the breed conversion is taking longer than we had hoped and that we needed it to. We quoted numbers previously that the impact was 20 million a month, sitting with the extent of the poor KPI performance of, and it's at the various levels of grandparent, parent, and then the broiler level. So it's a very significant impact. Our external feed business has been very challenged in this period. Why? Because the input cost is so high, and that's just the normal cycle that it follows. Farmers will, make a plan. They will force their animals to eat off the land. They will just buy down in heavy or high price feed costs environments, and so that volumes are challenged in our external business. And as our own internal business recovers, obviously there'll be some improvements in terms of the volume of taken out into our own chicken business, but there's not many good points about the chicken industry at the moment, be it the master plan, be it the input cost picture, be it our own issue in terms of our breed being so compromised. So we need more time then.
Thanks, Rob. Is there any updates you can provide on volume recovery in the QSR segment? Is this back to pre-COVID levels, and what level of disruption do you expect in the event of a stricter lockdown measures?
So clearly, if we go down back to the highest level lockdown as we did last March, that's going to have an impact. But we don't see that happening. It's just too disastrous an impact, and we've learned. Us and the QSR chains have learned how to operate safely in this new reality. So it was a while back that the volumes in the QSR sector got back to their pre-COVID levels. They're still there, and it's surprising only to the extent of disposable income constraints that people still what is a spoil? It's not an inexpensive meal to eat and take out, but maybe what's happening is there's because there's still restrictions and lack of or an appetite for sit-down restaurants. People are making more use or equivalent use. It's just a different audience of QSRs and takeouts. So the sector as a whole is trading from a volume perspective at an acceptable level. The dynamic that plays out in Rainbow's case is KFC are hell-bent on bringing other suppliers into the mix. So where we had a dominant share of their business previously, that is being reduced. all that means is that we have to resolve those birds into a different mix. And generally, the mix that we have to then pursue is lower margin. Certainly, if it's significant volumes, the only real outlet is IQF and retail. But if you look at it holistically from a market perspective, somebody else supplying the QSR is giving up that volume that they would have otherwise supplied into the market. So it just creates a hole elsewhere. So I think what we're going to find over time is all chicken producers in South Africa are going to shift to a more mix and spread across all customers and categories, as opposed to us having a dominant position in QSR and investing behind that significantly as our proposition. And KFC have gone away from that model, and for their own profitability reasons are chasing the lowest cost input into their system. So that's probably the most significant dynamic that's playing out within that QSR sector.
Thanks so much, Rob, for the detail. My next question is on the chicken master plan. Similar to sugar, what progress do you observe from this? And do imports still pose a threat to the domestic market?
So sadly, as I said earlier, not as much progress as we're seeing on the sugar side, and I haven't had for 10 years good answers as to why not. So yes, the market remains plagued by a level of imports, and there's always contestation about what really counts as imports and whether MDM as well as prime portion should be referenced. But I think most people miss the point. I think this audience get the point that it's all about cost attribution. And so what's happening is there's no cost attributed to the preferred portion of the brown meat here in South Africa. So leg quarters come in here with a recovery mindset. It's a byproduct of the first world markets. They sell and recover all the cost in selling the breast meat. So it's where we average cost our birds, they've got that advantage over us. So whatever product lands in this market is at a cost advantage to us, not because the total cost of the bird is any different. In fact, we are more efficient than every European nation. We quote this often. Clearly, we're not as efficient as Brazil, just by virtue of the size of that industry. And their proximity to lower cost inputs, maize and soya predominantly. So yes, it is still classic dumping that happens into this marketplace. However you want to see it, it is lower than it used to be. So the tariffs that came in place, I think it was last March, the increased tariffs have helped. There's no doubt, but it shows you how sensitive that situation is. So yeah, difficult market space remains.
Thanks so much, Rob. We have a question from an online participant, but posted anonymously. If you could kindly comment on the short, medium, and long-term focuses and plans for the chicken business.
Sure, we can ignore the long term for now. It's very much a short term to medium term focus, and it's no different from what it was a year ago. 18 months ago, we knew that we were in the throes of a very difficult breed challenge. Sadly, only probably 3 months ago did Tysons, who own the Cobb breed, actually admit to it, despite all of our taking it up with them many months back. So the breed issue is the predominant focus. So it's an internal challenge that we are switching breeds. In the interim, what we've had to do to accelerate it is make use of whatever breeds are in the marketplace. Why? Because any of the other competitors is performing better than the Cobb line. And it's so desperate to have to admit that, but it's the reality. So what we end up having is a more difficult agricultural space. I feel for the managers out there, because it's hard enough farming one breed. You get to know it, and it has peculiarities. When you've got different breeds in the same region, even that's a challenge. and we're going to live with that for a while until we can replace all of those flocks. And then, as I said, you know, the input cost challenges are just kind of on top of. You know, I think the new team that have come in are trying their best, but you know, it goes back to that conversation of what can you control. And IQF pricing, I'll contend, is not something you control either. So if you do your best within that space and you try and position yourself with and the whole industry with not having too much product at any point in time, so that the retailers can play you off. But you know, you've got a declining KFC customer in our space. You've got agri challenges, you've got input cost challenges. We've actually had significant disease challenges as well. That's not limited to ourselves. You know, a while back there was salmonella. More recently, in AI. I mean, it's relentless in the chicken space. So a very big challenge that we're still living with, unfortunately.
Thanks, Rob. If we can perhaps move on to the Vector Logistics division, could you kindly provide an update on the network consolidation against the March 22 timeline?
Sure, and no change to the previous update. We're on track. It was there was, with the exception of one, no reason why we shouldn't be able to deliver on the plan. And just for the audience's sake, just to repeat what was happening within that space, we only took over 3 of RCL's facilities. That's all we needed to supplement our network to be able to take on their volumes. And what we chose to do is do build outs at Tukwini Peninsula, so that's Durban, Cape Town, Bloemfontein and Polokwane. And so that was always going to be on the timeline in terms of how quickly we could expand those existing footprints of ours. So it's on track for March 22. There's one slight delay, and that's here in Tukwini and Durban. And that site was riot affected, unfortunately. So we were operating out of a satellite site while the build was happening. And that was in Cornuvia. It was one of the sites that were looted, sadly. So the Tukwini team got put back, but it's a month. It's not a very significant delay. So by then the new footprint will be in place. More importantly is the fleet consolidation that can happen as a consequence of that. You've got now one fleet operating out of one site. We've rejigged the size of the fleet that we are able to use. Obviously, operating bigger volumes out of bigger sites means you can give the bigger rigs going to bigger drops to our bigger customers. There's efficiency in that too. So not only we are only running one fleet out of one premises in each of the locations, you know, it's a better footprint of fleet size in terms of their tonnage. So Vector's on track. You know, F21 demonstrated in line with the expectation, the turnaround. To date, we are on track for the second kind of uplift of that as the duplicate costs come out of the system, which, as I say, will all be gone by April next year.
Thanks, Rob, for that update. My next question is just around cost pressures in the business, noting recent fuel price increases and so forth. Is there any commentary you can provide on that against a margin expansion in that business?
So yes, it's another example of a challenge, and obviously it's pervasive not just to our distribution business, but it's a very significant input cost, fuel and any source of energy. But in Vector's case, there is some level of shielding of it. Why? Because the majority of their contracts are on a see-through basis. And so we charge for the service, and whatever the fuel price is, you know, every 3 months just adjusts. So there might be a small lag, but I would say as much as 60 to 65% of the business that Vector does is on a flow-through basis from a fuel perspective. So there is some shielding for them, which is important because they're a business that runs on very thin margins, and so it's not as though they can take that risk on behalf of the customer base, and any hedging that takes place then happens on the customer side.
Thanks so much, Rob. We have a few questions that have come online, and just a reminder to the audience that if you would like us to ask a question to Rob, please do post your questions online. So we have a question that's been posted anonymously. I would say a bit of a broad question, but what do you prioritize in terms of volumes versus maintaining margins?
Difficult question, because my answer might be different in the different categories. In some areas, the volume throughput is the senior partner, and a broader story around brand positioning. In other categories, our brands are strong enough for us to sustain the margin, no matter what the price is, within reason. The consumer will understand it and choose our product. And so it's a blend of both. My personal thing is more around volumes. I think generally in the food business, scale talks, and throughput through big facilities is important, and that economies of scale is valuable to us. And margins will ebb and flow regardless of best efforts, and so we've just got to keep a sight on that without allowing the volume to be compromised too significantly.
Thanks, Rob. We have another question online that's been posted anonymously, but the question is, do you see any different interaction between RCL and Remgro in the future?
No, to be honest, we've enjoyed a very close relationship and support from them forever. Obviously, we got a lot closer in terms of working day to day as we went through the strategic review. They were a key party in those deliberations, and we've settled on what everyone's seen as the announcement in terms of how we want to take the business forward. There was obviously very robust debates within that. But we think we've landed at the right place with the right intention around taking each of the businesses forward and realizing maximum shareholder value in whatever shape or form that needs to play out. So we're not being prescriptive in that regard. So no, they remain a very supportive shareholder, and so no change.
Thanks, Rob. And that's all the questions that has come through online. So Rob, thank you so much for your time today and for providing the update. I'm not sure if there's any closing remarks you'd like to make before we end the session.
No, obviously there's a lot of activity in the market with our competitors and mostly internationals coming in looking at assets. So maybe just to repeat something that we've said, we're very intent on growing our value-added component of our business, whether that be organically or via acquisition. So there's lots of shifts happening within that space at the moment. We are very keen to take advantage of whatever opportunity presents itself. We remain inquisitively from the mindset and approach point of view. We've got, as I said, Remgro backing us in that approach and strategy. So yeah, exciting times ahead as we settle the balance of the portfolio into whatever the future holds for it. So yeah, exciting times.
Thank you, Rob. Thank you so much for the opportunity today. Much appreciated. To our online audience, we thank you for your participation and we hope that you stay safe.